As the famous venture capitalist John Doerr once said, venture capitalism is not about the money, it's about the people. Our speaker today embodies this philosophy and has spent years investing in and working with talented individuals to help them grow their businesses. Good morning, everyone. I am Bhavika Rumta from Team IRIC, and it gives me immense pleasure to introduce our distinguished guest for the day, Ms. Sonakshi Gupta, who has been a part of the dynamic world of venture capitalism for more than 4 years. Ms. Sonakshi Gupta has topped her CA examinations with an AIR of 37 in the finals and holds a bachelor's degree from Narsi Munji College of Commerce and Economics. She started her She started her career as part of Aditya Birla Group's prestigious finance leadership program. Since then, she has had several stints in finance and strategy, spanning multiple businesses in India and US. Before joining Aditya Birla Ventures, as part of the investments team, she worked with the corporate finance function at Ultratech, focusing on restructuring, financial analysis, investor relations, and driving various finance transformation projects. In addition to her work as a venture capitalist, Ms. Sonakshi is a published writer, having authored many research papers and articles focused on banking, economics, and tax. So, without further ado, please join me in welcoming our esteemed guest, Ms. Sonakshi Gupta, to the stage. Ma'am, we are honored to have you here today. Share your insights and expertise.
Okay, so good afternoon, everyone, and thank you, Bhavika, for that really warm introduction. I think really kind of you, and feels great to be here. So, the purpose of this session was to cover a little bit about venture capital, what it is like for beginners, from very basic, scratch, etc. Because I was also on the other side a few years back, and we would really look forward to such sessions. Especially, I think venture capital being something just to talk of the town right now would be great to understand the nuances of the industry, etc., how it all works. But also, we would really like to keep this session really interactive. So, as many questions, whatever you have, a single term, full form you don't understand, just shoot your questions. Would love to answer it because it's going to be a two-way interaction. Won't keep it a monologue. So let's make it as interactive as possible. And just feel free to shoot any queries you might have, any real world questions, also anything related to let's say the funding winter or any thing which you've heard about in the news. Would love to discuss that as well with you guys. So let's keep it that way and look forward to taking it. So I'll also
Just an interruption. Okay, guys, we have our Slidos. We'll just be sending you the links. If you have any questions, you could put it over there as well as you could physically ask. That's just for the convenience.
I also request if you just put the white.
You want proper white card? It's writable.
It's right.
Yes, ma'am.
Will be visible to them.
Yeah.
Okay. Yeah. Right. Okay, great. I'll require later. Okay. Great. So, am I audible to everyone at the back as well? Okay, cool. So, before I start with venture capital, just want to understand like what are your expectations from the session and what are you looking forward to this? So, so at least meet expectations, don't miss out on anything. So, just want to gauge that from you guys. Come on, guys, let's keep it very interactive. What do you all think is going to happen in the next 1.5 hours? What are we discussing? You can just shoot pointers, etc. Anything. Sorry?
Like from how to value a company, what you look for as a VC, maybe the team, maybe how you look at their value offering, maybe how their revenue model works, and stuff like that.
Okay, got it. And also, just trying to understand what is your idea of venture capital? How do you understand venture capital? How much you know about it? What have you heard about it? So anything that you've heard about it, and what is your understanding of that? Yes? Come on, guys, just speak what's in your mind. We're going to keep it super interactive, and let's not just keep it, me speaking. So anything in your mind, just feel free to bring that out. Sorry? Lifeline for startups. Okay, interesting. What else? Okay, interesting. What else? Come on, something from this side as well. Anything. If you heard about venture capital, anything recently, what if you read about it? What comes to your mind? Okay, what comes to your mind when I say venture capital?
Yeah, BlackRock.
Okay, yeah, that's an interesting answer. What else? Someone from that side. Come on, say something. Yes? Okay, let's just go ahead. So basically, the idea of this session would be, so we'll cover all these things. Maybe, what is venture capital to start with? Who needs venture capital? Who looks for venture capital? A structure for venture capital fund, like you invest money, where does it come from, and why do VCs even invest in startups? How do they make money? So we cover that flow. And venture capital industry landscape as it stands today, and how has it grown over years, in India. Venture capital process, like he mentioned, from talking to a startup, sourcing, etc. What are the various stages from actually closing an investment? And methods of valuation, again, we can see the most prominent methods that we use in venture capital. We'll also do a short case study, which is also something picked up from Aitabala Ventures, which is a real company we invested in. So we'd love to discuss that also with you guys, and then we can just keep it, any other Q&A that you guys might have. But having said that, the Q&A can go through other sessions, so just feel free to shoot any questions you have during the course as well. Okay, so just to, the first one, very basic, when I talk about what is venture capital, it's a type of financing, okay? And as someone here mentioned, it's a lifeline for startups, first round of funding. Might not say the first round of funding because that's usually, angel investors who are individuals. So that's like an angel investing. But when I talk about venture capital funds, they usually come in, from a seed stage wherein, okay, they just have an idea on paper and they're just starting off with their product. So it's a type of financing for small companies, but which have a long-term future potential. So we'll cover these two parts separately, in the slides ahead. So now talking about who needs venture capital, right? So like you mentioned, startups, small businesses, etc. But okay, but before I start with that, let's say, a startup needs venture capital. But what are according to you, what are the various sources of funding available to any company which starts off? Like equity is one. What are the sources do you think, a startup can start off with? If they need money, let's say you want to start a business tomorrow. Where all will you go to actually get money for that business?
First step is FFN family.
Perfect. Right, absolutely. What else? Yeah.
Advisable with debt.
Debt. Okay. No, that's something a lot of people resort to, of course. It has its own benefits. We'll cover that. And what else? Investors. Okay.
Crowdfunding.
Crowdfunding. Who said that? Yeah, quite interesting. Crowdfunding is something a lot of people do. In fact, just to bring that out, there are startups which also help, startups for crowdfunding. So yes, okay. Interesting. What else can you think of? I think you've covered main sources. Yeah. Banks. Okay. Yes, amazing. And a lot of, I think, institutes, not sure Nalsar has one, but also have their own incubation centers. Great. What else? Okay, but I think you guys have covered most of the points, which are there. So so usually a startup who needs capital, okay, they would either use their own savings or go for external funds. And so, exactly which was covered over here. And within that, like someone even said loans, right? So that is also a lot of, option that people resort to. But equity, when, someone raises, which is basically when they raise fund from investors, venture capital, that is what you call as true venture capital, which is venture equity. Now, so you all have a basic understanding of debt versus equity, right? What's the difference? So what do you think would actually make someone go for, equity over a loan in a startup? What are the benefits? Like nowadays, if you see 80-90% of the startups would want to go for venture funding as compared to a debt, etc. So what do you think is the benefit of an equity over debt? And that's precisely the reason why most startups today resort to venture capital funding. And like you all mentioned, friends, family, etc., is of course like very initial step. But once they've exhausted that money, etc., then they resort to venture equity. But what is the benefit of venture equity that they get from startups over the other source of funding? What do you think is the answer there? Correct, that's right. What else? Okay, got it. And so they also get money as and when the business needs it over stages. Okay, absolutely. What else? Yeah,
That I would have to pay some fixed interest payment for.
correct. So there's a fixed obligation and at a fixed time that you have to pay it. What else? Absolutely, very valid point. So basically, it increase the credibility of the company as well. That's how you can put it. Okay. What else? Great, but I think again, you have covered a lot of points because this is very basic, which I want to touch upon, before I go into the details. So, like, no fixed obligation, which a lot of you all said over equity, no cash outflow in terms of, interest payments, and of course, till, break even is reached. So, as the word which we use in the venture capital ecosystem is cash burn. So, there's a lot of cash burn, which means your expenses are, way over the revenue. So, to meet that on a year basis, you resort to venture capital because you don't have to repay it on a fixed basis. Then scale business, capital expenditure, team expansion is the various utilization of the venture capital fund. And like someone said, timely advisory and mentorship from the funds because they've been there, done that, so that becomes a huge advantage. Okay, now I think this is a very important part of how a venture capital fund is structured and a little technical as well. So basically, when you have a VC fund, okay, they have money like you your Axel raises 1 billion fund, Sequoia has a $4 billion fund, etc. But all of this fund which is there is basically money coming from various sources, right? It's not their own money which goes into the fund. So just to give you a background of how a structure of a fund looks like. Okay, so for example, here you have like your investors, limited partners, as you call it. So this basically includes two types of investors. You have an anchor investor and then you have other investors. Now, anchor investor is someone who basically puts, let's say, 15-20% of the check in the fund, and he is the main investor in the fund. So even when you say, let's say, a Sequoia raised a $4 billion fund, so 10-20% of that would usually come from one big investor, which could be some sovereign wealth fund, which is governments of other countries investing in venture capital funds. It could be university endowments because all the pension money, etc., which they collect, and that gets invested into venture capital funds. So the ones who invest in a venture capital fund are called the limited partners. So that's how we typically define it. Apart from the investors, you have a lot of family offices which are there. So let's say you have TVS Capital, Mahindra, or even an Ambani family office, etc. So all of these guys also look for different venues to deploy the money they have. So they're again a major part of the money which goes into a venture capital fund. After that, you also have your high net worth individuals, which are HNIs. So you have your, even celebrity stars, unicorn founders, etc., who invest money into a venture capital fund. So they, of course, it's a very small proportion, maybe 1 crore, 2 crore rupees, etc. But that's how the entire corpus of a fund is built. So the one who manages the entire corpus is your venture capital fund, which is called general partners also. So limited partners are the one who invest money in the fund, and the ones who manage it is basically it's the VC fund, but the partners are called general partners because they're in the operating side of the business. So that's how it's defined. Now, this venture capital fund invests in startups, but it's not as easy as it sounds because whenever you raise fund, okay, you have a lot of mandates down. Okay, if you're raising 100 crores, you have to give your investors before they invest money an entire chart. Okay, how will you deploy the money in each company? How much will you put? What will your ticket size? Ticket size is the amount of money you put in one startup. So how much will that money look like? And someone said follow-on rounds of funding. So if in the first round you come, how much will you put? In the second round, how much will you put? So all that needs to be decided at once, which is basically the fund strategy. And based on that, you invest in startups. Okay, now in the startups also, like you have to decide, we'll probably cover that in subsequent slides. So startups also, you have to decide your sector focus. So you have some which are just consumer focused startups, some are just into fintech, some are just into SaaS, software as a service, etc. So all those things also you have to chart out when you're laying out the strategy of a venture capital fund. That's how it works. And also now we'll talk about how the entire venture capital fund makes money. But is anyone aware of the process of VC investing, and how do the money how is money earned to venture capital fund and the investors? Like, why would they invest? What is the upside for an investor to invest in a startup versus he can simply go and invest in the equity stock, or he can go and invest in some other company? Why will he come and invest in a startup? What is the upside? Okay, so that's the exit opportunity that they get. Yes. Sorry?
Easy promise.
Correct. That's right. Higher return. Correct. Okay. Okay. What else? Okay. So I mean the points are valid. So I can just write with this, right, on this. Okay. Got it. So let's say, for example, a venture capital fund invest, let's say 10 rupees today in a startup. So, and the way it's, the way we look at the metrics in terms of venture capital fund, we look at two important things, which is called IRR, which is your internal rate of return, and then we call MOIC, which is your multiple on invested capital. So these are two important things you look for when you're actually investing in a startup. So let's say now in year 0, you've invested 10 rupees in a startup. And like you said, the main purpose is your money remains illiquid. In those, let's say you've invested, okay, after 4 years, I want to exit the startup and make money. Okay. Now 10 rupees you've invested in one startup, but for 4 years, you cannot remove that money at all because it's illiquid. So that is also one disadvantage of VC fund, but that's why the people who invest are really wealthy. So they anyways don't care कि ठीक है 4 साल बाद भी मिल जाएगा, but मिलेगा तो बहुत पैसा मिलेगा. That's the mentality which is there. So 10 rupees you invest in a startup. Let's say in year 4, okay, your money becomes 100. So technically, the MOIC, the way you calculate MOIC is your 100 divided by 10. So you make 10x money on your invested capital. So usually that range has to be very high in case of venture capital investing, because you come in very early and you exit when it's like super big. It's a unicorn, or it's in Series C, Series D stage, etc. So multiple on invested capital is a very important metric which investors look at when they invest in a venture capital fund. Then you talk about your IRR. So like, for example, when you invest in a bank FD, the bank will tell you you get 8.5% return on a year-on-year basis. So that's basically the return you get on an annual basis. But in case of VC fund, you don't have an annual return. It's year 0, year 4, and that's it. So you equate it in such a way, okay, 10 rupees plus X% plus X%, etc. will give me 100. So that X% which you get on calculating it, how much you get each year, plus 10%, etc. will give me 100 at the end of 4 years, or plus 20%, whatever. So that is called your internal rate of return. So that IRR is, at least 20-25% is something a VC fund should look for, because then it does not make sense. If it's, less than 20, you might as well invest in equity market or some other investment, because you're playing in the VC ecosystem only for massive returns. So these are two important criteria which every VC fund and investor has to look for when you're investing in a startup. So that's an important criteria. Now, also one more thing which is a very interesting analysis which has come over the years. Okay, but before that, everyone's aware of like seed, Series A, Series B startups. What do they mean? Or I can just throw some light on that. Okay, but just in case by chance someone doesn't know, so seed is before seed also you have like someone said angel investors, friends and family. That's something which comes before seed, pre-seed you can call it. And then seed, series A, the second round of funding, third, fourth, fifth, etc. As the round increases, that's how you keep calling the series. So typically, if you look at the most amount of money goes in your seed stage, and then if you see the number of startups which reach till this stage are very few. So the risk is massive at this stage because very, very few startups actually succeed, and most of them fail in the process. So even in a venture capital fund, let's say if you have a portfolio of 100 companies, only 10 companies might give you money. But they make up for the losses in all the other companies. So 90-10 or 80-20 is usually the ratio of VC fund. So that is something which a lot of investors keep that in mind, and that is why you have a lot of these terms called micro VCs. For example, 100x VC is an example of a micro VC. So what these micro VCs do is that they literally, like for example, there's one VC which is situated in Mumbai as well, Venture Catalyst, etc. They literally have walk-in pitches in their offices. So they'll say one date, let's say next Friday, all startups are invited, etc. All startups literally come, they accumulate in a conference room, and one they just keep calling number by number, and they just give maybe 15-20 minutes, maximum half an hour to that startup, and they decide on the spot if that startup has to get funding or not. And some of them are just an idea on the paper, but their logic behind doing that is just spray and pray kind of, spread your wings as much as you can possible, and then even one of them does well, you're sorted for life. Because even if like you put one crore in each of these startups, that 1 crore also, if any one startup cut becomes 100 crore, you're done. You've just made your money. So that's the approach a lot of micro VCs follow. Okay, and so basically these are different type of VCs. Micro VCs one, then you have early stage VCs which come in after the micro VC stage, which is seed to series B. So that is something also what Aditya Birla Ventures does. So we try to come in once some product market fit in the company is set up. Okay, so at least there is some consumer traction established. We know the product is working. We know the tech is defensible, etc. So that's how you do. That's how early stage investing is all about. And then after that, you have your late stage VCs, which is also confused a lot with private equities, because they typically come in and for private equities, like how in a VC, if you look at the invested capital, it should be 10 to 15x. In a private equity, it could just be 2 to 4x, because they come in so late. So the later you come in, the lesser you get the gain of the valuation expansion, because already the value has increased so much. So let's say the value here is 10, probably 50, 200. So here will just increase at a very marginal space. So that's the difference which happens stage by stage. Okay, but the amount of money you put in is huge. So even if you get 2x of that, it's phenomenal. That's how private equity is built out of. So a lot of prefer diversifying their portfolio at a seed stage as well, because so that's why you will see the word sector agnostic used very often in the VC ecosystem, because everyone's like, okay, even if they started off saying, okay, we're a consumer VC, we're a fintech VC, everyone nowadays is like a sector agnostic, because if something good comes, no one wants to miss it, right? So because you want to just spread your wings as much as possible, and then you're, because high risk, high return, that's how you play. So this is basically typically how the structure of a VC fund looks like. So I think just cover these points: diversify investments, high risk, high return, earlier the investment, higher the chance of valuation expansion. Any specific questions on this so far? Yeah.
Okay, so we don't need a bootstrap model. We need the venture capitalist fund. Here you discussed about the loan and the debt.
Correct.
Why not the bootstrapping? We can go into
Correct. So bootstrap, a lot of people do, but again, you need money. Okay. So a lot of people, if they're maybe from wealthy families, like yesterday only we spoke to one startup, called the Pant Project. So Pant Project, yeah. Okay, so that's basically into customized pants. And like you mentioned, he's a bootstrap startup, doing phenomenally well in terms of unit economics, numbers, etc. And but he could afford that because he comes from a good family background, strong business, etc. So he could make money. But a lot of people might not have the resources to get bootstrapped. So that's the reason, then you decide, okay, so first question the startup founder will ask himself is, do I have the money to bootstrap it? If no, then I will see which source to go, debt, equity, etc. And if debt and equity, then we can see the, benefits. Okay, debt, I don't have fixed obligation. So it also depends a lot on the person and his background, resources, etc. Did I answer your question? Okay. Yeah. Correct. Yeah.
all mixed.
Yeah. You mean the money? So here, the limited partners who invest the money in the fund, so they use this money to invest in startups. Yeah. Yeah. No, so for that, that's a good question. So SEBI has it's called Alternate Investment Fund called AIF. So you need to register as an AIF. Of course, like you, me, we come together, we invest money, that's okay. It's not formally called venture capital, but we can invest. But formally to qualify as a venture capital fund, SEBI has a process and you have to go through the registration. And that process is under alternate investment funds. So that's a detailed, it's like a compliance thing which you have to adhere to. Yeah.
Ma'am, I have two questions.
Yeah.
First question is like, what preparation should a person do getting then like how much ideas like do we need to prepare a whole idea and then all the reports, whole idea that what could be the potential? I want to ask like, do we need to have a proper resource for that? We will be like getting supplies from there or making that supplies from particular thing. We just need an idea and an estimation that this would be like we would work like this.
Can you come again with your question? I'm sorry, I didn't get the crux of it.
Ma'am, my question is
Yeah.
that what preparation should a for- before getting into this when getting in the like when venture capital that we want that we so that like
You're asking from the startup perspective.
yeah
Okay.
how much preparation should be like but we should be like you said we should be have an idea and it works so like that idea also like how much preparation should be done by
Got it, got it. So see, the way it works is that if you have an idea or something, I think you should first, model it in terms of what your business plan looks like. So if you say you have an idea to manufacture something, so then the approach would be, okay, I go out, I see the industry, how big that industry is. Okay, because VC is technically talking $1 billion in terms of industries. Anything less than $1 billion useless for a VC to invest in because scale ही नहीं है. So you should see how big that industry is. Okay, you will get a lot of industry reports, a lot of matter on the internet, or just go out, cold reach out to people and understand how big is that industry, who are veterans in that industry, and then you see, okay, if I, enter in this industry, how much market share can I capture? So when you have an idea, the way you validate it is by seeing if that idea is scalable or not. And the way to go about doing this would be to collect some industry data and see how much the market is, how big the market is. So then if you get, okay, the market is big enough and there are not a lot of players, it's not very crowded, there are not a lot of barriers to entry as well, and I think I can make my mark in the market, then maybe you can go ahead. And then you can do, it's called a pilot stage. So if it's a product, then maybe you can give it to a few people around, etc., make them try the product and whether what's their feedback, work on it, and accordingly you will understand if it's worth going ahead or not. If it's a tech application, then it's called like a beta phase. So you give it to people, to download the app, etc., and then you see what's their opinion on it. So that's how you validate your idea. And then once that is done, then maybe of course you can go to different types of investors based on the funding requirement. Yeah.
Now you said well, you enter a market, the startup market with a valuation of a billion, over billion.
Not valuation, industry size of
Size of more than 1 billion.
Yeah.
He also mentioned that for a startup, it's better to have less players in that industry. So, if having less players, still having a valuation, still having the worth of the industry more than a billion, that means that there's a monopoly, right? Of the players are big in worth, big in value. So, for a startup, would it be healthy to going in that
Correct.
industry?
So that's a good question. So that's how we evaluate a lot of consumer brands. Okay, so for example, if you see beauty and cosmetics, okay, or even apparels could be a $4-5 billion if I'm looking at a premium price range, 2,000 rupees plus. But you have some monopoly or apparels might have some brands that are doing very well. Okay, but still you have a lot of new age brands coming up. So the way it works in that market is while there's a monopoly, customers today, okay, because we've also got this consumer survey done for a couple of our portfolio companies, they're actually willing to try new products. And so you, like, for example, you establish a moat in your business. Okay, if it's a new age cosmetic brand, they will say we use organic chemicals, Mama Earth. It made it enter in a very crowded market. So they are using organic chemicals. So you identify the moat and how it differentiates yourself from the existing brands, and then you can do it. So even if there is a monopoly or not, I think it depends on how you're differentiating yourself and positioning your brand. So then you can still make your way. Yeah. Anything else? Okay. So let's move on to the next one. I think it's. Can I just get some help on changing this?
Ma'am,
Yeah.
meanwhile, what's the criteria for the same venture capital fund to reinvest in a firm from seed A to seed B? Because let's say if the valuation doubles, if it's a 1 crore investment, if it's a 10 crore valuation, it's now it's let's say 1 to 20.
Yeah.
So for the same amount, you're getting half the equity you're getting in the second.
Correct.
So how
Yeah.
does that factor in? Because
So yeah, that's again a very good question because that was something we were just doing for a recent portfolio company. So the way it works is you kind of do your, so the first time you come in, you do your risk return analysis. Okay, 4 years down the line, how much is going to get to? So you do the same working again. So now if I come in with this 20 crores, how big can that get to? So then, at least in absolute return, you will still be making some money. So, and not all VCs do the follow on because nowadays, especially, they become very conservative because they put in money when it's, super early and then they realize that it's not even profitable. So then they don't even do it. So they do their entire working of the IRR MOIC again for that amount and then see if it's worth doing it or not again. Yeah.
ma'am, what about industries that end up, let's say, have smalling up under time? Like something like a crypto industry or an FTX
Yeah.
2 years ago had a massive valuation.
Correct.
Today it's nothing. But what happens in a way where a VC has invested billions of dollars? Is there any way of retrieval of any of that, or does that go?
No, so even like Seco had given that entire letter to its LPs where they had to literally write off the investment. So legally, I mean, you can so the way it works is some investors who are putting the bulk of the money, they get a preference. Okay, so whenever the company liquidates, etc., so you have to at least repay my face value of the share or something like that. But honestly, if a company is doomed, it's doomed. Like you literally write it off. So even in that, I forgot the name of the company, but $32 billion, I think Sequoia wrote off in a crypto company. So all those things happen. Like it's a huge risk, and you simply write it off because there's no way of retrieving it back. Yeah. Okay, should I go to this one? So this is just an overview of how the venture capital industry in India has evolved. Because while it picked up in 2014, etc., then the second wave picked up again in 2021. 2022 has been slightly dull, but of course, it's still venture capital still has its buzzword around. But that's how the industry has grown. So you have the amount of invested capital, which is again $1 billion, which the total amount has gone into startups in India. So it's just been massive. Like there's been a 4x increase from 16 to 22. So in 22, $23 billion worth of venture capital money went into the startup ecosystem. So that was just crazy. And against 12 billion, let's say 2 years back. So the amount of optimism in the ecosystem is just increasing day on day. And there's so many new VCs also coming up every second day, realizing that it's, a great game to make money. So a lot of money is being pumped up right now in the ecosystem. Even number of deals are going on. But just to give you a scenario, because of the entire funding winter, etc., going on, so number of deals in C to Series A are increasing or doing well, but Series C, Series D is a very slow market right now because of the fact that profitability, unit economics, sustainability is something VCs are very strongly focusing on right now, which they did not do earlier. So that way the market is a little lull, but Series A investments are still at their all-time high, etc. Now, typical sectors which a lot of venture capital funds look at, and I think consumer tech kind of consumer internet tech tops the sectors. So just to give you an example, so your consumer internet startups would be something like, let's say, an Ola, Uber, or Zomato. Food tech is also a part of consumer internet. And then you have your fintech, again a very big game changer which is there. So these are basically different sectors. Would be more than happy to discuss on emerging themes in the sectors in case any of you have questions. So different sectors, and but just to consumer tech and fintech are still the favorite of the market right now, given the massive amount of potential. Because also one more thing to highlight here is a lot of startups today are focusing on your tier 2, tier 3 cities, because metro cities are so saturated right now. They realize that bulk of the demand is going to, so wherever there's a scope for development, that's where the bulk of the demand comes from. So much scope of development they see in tier 2, tier 3 cities, etc. Even on dating apps. So recently, you have a lot of dating apps which are working in metro cities. So recently there are like dating apps coming up which are, just for people in remote areas to interact in vernacular languages. Like that's how people are thinking. Everything which is then metro, how can I solve it for your remote areas? And the market there is huge. If people come to know about it, the word of mouth spreads so rapidly. It's very easy, and it's a big platform to make a business over there. So that's a lot of like basically that trend is being seen very optimistic right now by many startups. These are the key sectors which are there, and even the unicorns. Okay, so like unicorns are those startups which are valued at 1 billion or more. So they've been like growing phenomenally for India, because if you see in 2021, okay, the number of unicorns in India actually surpassed that of China as well. So it's just crazy, because of course that's another thing. There are a lot of, not lot, 2 3 unicorns are not even unicorns anymore because the valuations took a downturn. But the point being, of course, they were unicorns at time. So India that way is becoming quite a hotspot for venture capital investing in general, and US still tops the list given the entire tech scene over there. That's how the landscape looks like. Any specific questions on this? We'll be happy to discuss. Or any points you'll have to share, your experiences, any inputs on this? Yeah.
Money. Like they want to expand.
Yeah.
There will be expenditure of that money, which is which can be also the potential customers for other.
Startups itself, right? Yeah. That's in fact a very good point, because a lot of startups which are into lending, etc., they do it for startups only. But like pura ecosystem ban gaya. So there's a startup called Giraffe, which is into well tech, whatever. So it invests into some fellow startups only, like PharmEasy, etc. So within the startup community itself, they're like big customers for each other. That's true. There's another startup in the employee insurance space, and they provide insurance to employees of other startups only. So that entire startups are also like just customers for each other. Very valid point. Cool. Okay, should I go to the next one? Okay, so this is, I think, the heart of how a VC fund works like, and basically what a day-to-day role in a venture capital firm looks like. So the very first point is sourcing. So, okay, I've already put it on the screen, but according to you, what would be the best way to source a startup? Like, let's say, ignoring what's on the screen, naturally, what do you think would be the best way that, you get startups to value deals, etc.? MODs.
Demo days.
Demo days. Quite interesting. Yeah, a lot of VCs do that. What else? Are you guys following till here, or are you sleeping there? Okay, great. So a lot of sourcing. Okay, the first step is identifying quality startup. So I think what differentiates a good VC from a not so good one is the quality of investments that you make, right? So quality of investments depends upon the funnel or the pipeline you have of those investments. So the way a VC would build a pipeline could be divided into 3 categories. So you call it like inbound channels, outbound, and then across the ecosystem. So inbound is something as simple as on the website you have a pitch to us form, or apply via the website. That's your website applications. LinkedIn is a huge enabler in this entire ecosystem. Cold mails on LinkedIn, reach outs, etc., are a massive way to get more inbounds. And then you have your outbound channels. So that is actually the most qualitative way, because then you ensure that startup quality you're reaching is good. So let's say, for example, a lot of my work would also involve, like I personally look at consumer tech a lot, okay, at Adabilla Ventures. So it would involve kind of reading up on the latest trends in consumer tech, India, globally, etc. What's doing well, what's not. Then identifying, sub themes under each industry, food tech, agri tech, etc. And then making a list of startups in these industries and reaching out to them. So reaching out to them would be either via mails, LinkedIn reach outs, etc. And then having a conversation with them, which is which goes to a next stage called evaluation, which we will discuss in detail. And across the ecosystem, like you also mentioned, demo days is something which is a very ecosystem thing. And if you have some good connects with angel investors, they'll also give you, opportunities where you can invest in seed, Series A, etc. So that becomes a good pipeline because they have to go to the next stage of funding and building good connects with fellow VCs. So if they're investing in a startup, they'll be like, "Arey, startup abhi paise raise kar, acha kar hai, dekh lo." So that's the network is extremely important in this entire ecosystem to source quality deals. So that's what sourcing is about. Before I go to the next stage, which is evaluation, what do you think you should look at when you're evaluating a startup? What would you look at? What are the key things? Scalability, absolutely. What else? Target market, okay. Of course, yes, that's very important, especially in seed stage.
Invest in the person who was there, and then the idea that he portrays.
Correct.
He's one who's or she.
Correct. And especially when you have an idea on paper, so there's nothing else but the founder's pedigree that you look at. Exactly. What else? So many things, yeah. Compound growth rate. Okay, what exactly would you look at there?
5 years, the compound growth rate.
Perfect. So also your potential to grow is also something you look at. How much can grow to? Yes. Sorry. I'm sorry, I can't hear you.
Static DCF. Static DCF.
Oh, okay,
Yeah.
DCF you're saying. Okay, yeah, okay. But honestly, you know what? DCF is not that much used in the startup space because you have no data. They do something literally very new. Companies would be very established. So for DCF, you need to have some data basis to, have future assumptions. Of course, that's a very good way for Series A, B, beyond. But very early might not be that relevant. But yeah, Series A, B, yes. What else? Okay, so that is kind of linked to how big the industry can get. Okay, revenue and profitability.
The value that company creates on its products,
Okay, yes.
service.
Okay,
Exit options.
exit options. Okay. So this is something also from an investor's point of view, which makes absolute sense. Also from an operating point of view, what else would you look at? Let's say in terms of business model, what else would you look at? Yeah, no, I think all your points are absolutely correct. Just I'm saying on the business as well. If someone says you they're doing this, that, from a business perspective, what we look at in terms of the business model, if it's a good business or not. If the Yeah, okay, which means whether is it actually even useful for the market? Absolutely.
You see, like how much it is retaining. So the
Very good. Yeah, that's something you look at, and that is something you look at with average order value. So it should be lower than your average order value. Okay, very good. What else? Yeah. So for that, there's this thing. It's called there's a gap in the market, but there's not a market in every gap. Like there's so many problems, but not every problem might actually be big enough to be solved. Yes. Yeah, because you shouldn't be burning too much also on a month-on-month basis. Yes, exactly.
the volatility of the sector per se. For example, in tech, there's a lot of
Correct. So yeah, maybe like defensibility of the product in tech because if it's even defensible in non-market.
Market saturation.
Okay, very good. So let's link to your market sizing and all of that. Okay.
how easy is the product. You have launched something, what if another company is come and is able to make the same thing you are making?
Correct. So that's again defensibility and how unique it can be and the moat in the business. Okay. Okay. Okay, like adaptability as well. Yeah, valid point. What else? Sorry.
Market complexities.
Okay, so what over there?
Three players.
Correct. That's also like barriers to entry, you would look at. Yes.
Shareholding patterns.
Yes. But what would we look at in an early stage business shareholding patterns?
PT, how much percent you'd be giving?
So how much the
percent you would get if you invest in that?
Okay, and one more interesting point, I'll just come. One more interesting point over there is, if a founder holds high equity, that's actually a positive because he has conviction in the business. So then you're like, founder's investing so much, he's very convinced and strong about the idea. So that's actually a plus point to the investors. Yeah.
Also, some blunders if you're asking for 2 to 3 crores for 2 to 3% equity, you're giving a your relative 10% equity just for the rent. That doesn't make sense.
Yeah, that's more like fraudulent practices kind of. But yeah, okay. Yeah, no, that's very important from an investor perspective because you.
But there are times that the stem of the idea it diversifies in multiple ways, and then we invest in the new stem that comes from diversification. Can be.
Yeah, no, it's absolutely, yeah, please just feel free. That's true. And a lot of people, in fact, just to bring it up, also pivot their business models very fast. Yeah. So because especially pre and post COVID, a lot of pivots have happened. They started something, realized COVID में तो कुछ चल ही नहीं रहा, and then they just pivoted, etc. That's true. Pivots are an important sign to look out for. What else?
What models actually like it is B2B, B2C? Did we expanded to further models?
Yes, bilkul. That's right. Because of course B2C would also involve more branding costs, etc. Yeah.
So these things are like attractive. So investors will go for green investment.
Correct. So it's called clean tech as a sector, that's really picking up. Even EVs fall under that. That's true. Great. So I think we've covered a lot of interesting points. So just to sum it up, when you actually to put it under broad buckets, but the points you've said would come under each of these buckets per se. So founding team, of course, pedigree, credibility, etc. matters a lot. Market sizing, which a lot of you all mentioned, industry related points, etc. would get covered there. Defensibility of the product and tech, how, like you said, it should sustain and how easily it can be replicated or whatever. So sector specific key performance indicators. So for example, if you, like a lot of people spoke about, I think revenue, margins, etc. But also, for example, if it's a consumer tech startup, so the core of a business is consumers. So consumer engagement is something you look at, monthly active users, daily active users. So these are very specific to a sector. Within fintech, you will look at how many loans is that given, what is the non-performing asset rate, which is the default rate, etc. So those things you will look at. Then maybe in case of like a software as a service, you will look at the number of companies it's working with, how many companies it's providing a service to. So these are some key performance indicators you will look at industry to industry. Commercial, legal, and financial due diligence is extremely important. So, let me give you a case. So, there was one very top VC, Tiger Global. So, they were actually looking at, investing in a startup, and they had almost finalized, okay, we will invest in the startup, everything was done, and the startup was just in its diligence phase. And then they realized, okay, and the way it works is, for example, they will hire some, big four or maybe some firm to do a diligence for them. So it could also involve talking to a lot of customers, seeing their customer feedback, what's their view on the products. Then later on, they realized, okay, so they took a list of customers from the startup. Okay, give me the list of customers you talk to, and you work with, and let me talk to them. Then they somehow just realized the number of the list they gave of the customers was exactly equal to the number of rows you have in Excel. So I don't know the exact number of rows, but let's say you have 1,000 rows in Excel. They have exactly a list of 1,000 customers. And that is something which is, it's a very rare coincidence to happen. So then they realized that that list was actually fabricated. Because, how can you have the exact number of rows? And they, took a deep dive and they realized most of the customers were fake. And then they pulled out the investment. So nowadays, the due diligence become extremely important because a lot of startups will just pump up their marketing, branding maybe a few months before raising funding to show the revenues increased because a lot of times valuation is based on revenue, and then later on you realize those customers were not even real; they are fake customers. So that's why due diligence becomes extremely important on your customers and whether actually are you working with them or not. That's extremely important today's times. So that's what commercial due diligence is all about. Then you do a legal due diligence, which is again, for example, you hire a legal firm for this and you see if they're compliant with all the laws. So if it's a fintech, compliant with all RBI regulations, etc. Consumer tech, compliant with all regulations related to maybe, addressing consumers, etc. Agri tech is, compliant with all government regulations in that particular area. So regulations become very important because penalties will have to come on investors only later on then. And financial due diligence. Financial due diligence is on the numbers. It's more like an audit कि आपने जो numbers quote किए वो actually सही भी है कि नहीं. So because a lot of people, even in US, okay, so there was this case, there was this lady called Elizabeth Holmes. You all have heard of the case, right? Yeah, so I think it's just famous. So she was just window dressing her accounts. So, and because I don't know, no one did a due diligence, everyone was, oh, amazing background, this, that, etc. But we all know where she is now. So that's why financial due diligence is super important right now. And then, like you all mentioned, risk and return analysis from an investor perspective. So, like the IRR and MOIC calculation I showed you, that's something we do when we invest in startups as well. So, how much multiple of our money can we make 4 years from now if we exit, and how much, IRR can we get in those 4 years. So, two important metrics we look out for, whenever we investing in startups. So once we have done an evaluation, okay, and we're convinced on all these aspects, etc. Typically, the way it works is each venture capital fund has an investment committee. It's called the IC. So which has 2 or 3 senior people from the board. Like for example, Nanta Billa, we have senior leaders from the group itself. Other funds might have senior leaders from the ecosystem, industry, veterans, etc. So every investment is usually taken to the investment committee for their go ahead. So they would probably ask questions, why are you making this investment? Is it even worth making or not? So once that is done, once their go ahead is got, then you finally decide to actually, say yes to the founder, and then you go ahead with all the transaction closing formalities. So the first step is sourcing, then you evaluate it internally. That's what typical. So these two is where most of the time of a venture capital analyst, associate, or partner goes into. And then after this is done, so then you do a transaction closer. So which is basically again a very important part, because nowadays in so many legal battles are happening. So it's very important that you when you're making the agreements, you finalize your rights properly. So rights could be, for example, okay, whether will I get information on a monthly basis? Because if you have a very small stake, you might not even get a profit and loss on a monthly basis. You have no control where the startup is going, kya kar raha hai. You've just basically made your investments or Bhagwan Bharose type. So that's why now they're also, focusing a lot on getting rights, getting that regular information to keep a control on the investment. And then, finalizing investment agreements, investment structure. A lot of the investments would be overseas. So SEBI regulations come in play over there. How should you invest in overseas investment? So those kind of structures you build. Just an example. Then how basically you want to invest through which entity. So all of those things come in play once you've said yes, okay, you're going ahead with the investment. And just to highlight, so for the investment committee, like we make an entire detailed deck which goes into presenting to the investment committee. So 4 or 5 things which are usually covered in that investment committee deck is basically your industry overview. That's how it looks like. Then your business overview. What does a startup do? And then you have key performance indicators, the financial metrics, how the use is going. Then we have a competition benchmarking. Competition benchmarking is that startup versus the other startups in that area. How far have they reached? What is the differentiation of this startup? And the last is the risk return analysis. So these are the 5 key elements of an investment committee deck that we typically cover when we take it to the investment committee. Then transaction closer, and lastly is your portfolio monitoring. So once you've invested, etc. So based on the information we get, regularly monitoring the portfolio, and like one of you said, also deciding for follow-on investments. So whenever we raise funds, whenever they are raising funds again, they come back to us. So that also comes under portfolio monitoring. So to see whether okay, is it worth investing again or not. So these are the 4 typical steps when you're actually making investment from sourcing to closure. Any questions here? Yeah.
How does portfolio monitoring works?
So the way it works is, so let's say for example, we have like 5 portfolio companies right now. So they have a fixed date. Okay, let's say 25th of every month, they will send us. It's called MIS, Management Information System, which is basically your profit and loss statement with some key indicators, how many users have grown, etc. So that they send us on a monthly basis. So we evaluate that. Okay, we see okay it has grown. If we see it has degrown, then we have a call with the startup founder saying why it has grown. So monitoring the business on day-to-day basis of why something has happened or gone wrong, and also providing some suggestions. Okay, you can do this to do better, helping with him on strategizing it, etc. So that's how you monitor the portfolio with them. And then let's say they're raising funding again. So then you call for all the data to make sure, evaluate whether is it worth investing again in the startup or not. Yeah. Any other question?
Invest in the same startup operating in the same, sorry, in different startup operating in the same
Yeah, we tend to avoid that because especially if that is something which is 99% cases avoided by startup, because the thing is when you're working with a startup in your portfolio, you're also helping them grow. So then if you're helping one startup grow, you can't help both to grow at the same time. There'll be a limitation of how much you can help. So that's why you usually tend to avoid that conflict. So even we've invested in Care, which is a healthcare startup. A lot of similar startups have been coming. So we tend to, avoid it because we already have a company which we can help. That's why. Okay? Yeah.
From a VC's perspective, what are the metrics that influence the economic capital? If it's only value at risks, the tail risk, do we consider only the tail risk of it? Or are there other factors, the internal decision making of the firm that also influences, or are there any other factors?
Yeah, so like I didn't get your question on exactly when you say internal decision making. Can you come again?
Say there is a life cycle of a firm, and the firm must take some, based on the life cycle, the firm must take debts or should focus on equity. And if the decision is not made properly, that would be detrimental. So,
Yeah. So see, that is, what, that has a lot of stages to it. So for something like that to go wrong, there has to be something really wrong with your governing body, corporate governance, because a lot of stages to it. So like while I told you there is a limited investor, venture capital funds investing in startups. So a lot of stages, while we look at, okay, a lot of risks that you said, but I mean, there are a lot of governing bodies in between each of them as well. Then you have a conflict resolution committee also, like, he said, to avoid conflict and all of that. So a lot of committees and governing councils to ensure that something like that does not go wrong. I'm not sure if I've answered your question. Is that what you were looking for? Okay, yeah. So then in that case, we have a lot of governing councils and committees to ensure, things are in check and they don't go wrong internally. Yeah. Anything else? Okay, let's move on. Yeah.
Does like in the transaction closure,
Yeah.
like does it also include that venture capitalist? Does that also take part in decision making? Board director of board.
Yeah. So we take a board seat as we call it. So if you hold 5% or more in a company, that's when you get the right to take a board seat. Because if you hold anything less than that, then you don't really have a control in the company. But 4% or 5% or more, you can get a board seat.
at the industry standard, or
Yeah, that's more the industry norm. It's an accepted industry norm.
Does it also include that for next fund before asking next funding, you have to take permission of the previous person,
Previous person meaning who?
previous venture capitalist?
Yeah, so in that, there is sometimes it's also, see, there's something called a pro rata clause. So in pro rata, let's say we've invested in one startup, so and we've invested, let's say, 1% in a startup. So when the next round happens, to maintain that 1%, we can put in additional money. So if to for that pro rata right, you don't need anyone's approval because that is your inherent right. Because मुझे 1% to maintain करना है, I will put in whatever it takes to get to 1%. If you want to put in more, then it requires, of course, consensus of the others on the cap table, and how much the founders also want to dilute and whether they want more money, etc. But till you're pro rata, no one can really trouble you because that's your inherent right. Yeah. So now coming to the methods of valuation, but before I come to that, I want to again hear from you. How do you think startups are usually valued in this space? You've heard about, and if you have any questions, because honestly when I joined this space I was like, kya ho raha hai? Matlab, on any number you get any multiple, and it has absolutely nothing to do with the business. It took some time for me to adjust the way valuations happen here, and I'm so happy it's corrected now because of the funding window, so things have normalized. But it was like super crazy, let's say last year this time. So, I mean, what is, even if not your, view on the methods of valuation, any, some observations around the entire valuation scene that you have, because that's something which is there in the papers every day. So, want to hear your, points over there before I go to that methods of valuation.
projected revenues could be one based on the
Okay.
TAM office.
Yes, that's true. Projected revenues is like a parameter to use. Yeah,
Comparable
correct. That's one.
market cap.
Who said that? Yeah. How would that work?
We can value the multiplying the price of the share into the number of shares.
Correct. But just in case that's of course a very good method of valuation. But in case of startups, you might not have that price per share, etc. So maybe you can do a pseudo price per share by taking of some other company because startups are like very early, so they don't even have a share listed, etc. But that's a very good method if it's listed. But yeah, of course, quite that can be used, or maybe you can take another listed company and see what's the market capitalization of that and apply to a similar startup. Disruptive technology. Okay, and how would you apply that to valuation?
Compared to any other food or any other non-tech startup.
Okay, got it. Fair enough. So we'll come to that. That's basically it's called like so tech companies use ARR based multiples, which is called annual recurring revenue. So because the way tech works is that it's a subscription based model most of the time. So if someone's used the tech, okay, they're likely to renew it again and again. So then let's say if it's made 10 crores a month, you multiply by 12 because assuming it every month to aega 120 crores, and then you multiply valuation. So because of that ARR effect, usually multiples valuations tend to increase. But of course, that's very common for tech companies. What else?
Valuations also tend to rise and fall right before an IPO listing, maybe the grey market premium that affects it because that essentially tells people.
Correct. That's true because that's in fact the reason even Farmeasy has been struggling to raise its IPO so far, and Mamaearth and all etc.
LIC,
also
yeah.
filed for it. So that's true. That's I think it's a big game honestly which happens. So yes, that's right. Yes. What other points?
Transactions.
Huh?
Recent transactions.
Decent transactions, absolutely.
As well as multiple approaches comparing the multiples of publicly traded companies.
Yeah, if you have some companies, yes.
As also cash flow statement.
Yeah, and public companies, you might also use some of global companies because a lot of times India is one step ahead behind, let's say, what's happening in China, US. So if a startup's already made it big there, you can, estimate कि ठीक है India में कितना ही जाएगा, and China even more because that's also developing. So developing to developing comparison becomes easier. So that's a multiple use, using global companies as well. You were saying something?
My question is not regarding this.
Yeah.
My question is regarding that when the venture capitalists choose the startup, do they also see that the person who is actually has that idea, because there may be two people with similar ideas, but we trust a particular person more, and that's why we fund that particular startup.
Yeah. So are you so just to like re-understand your question, you're saying let's say if there's a similar idea by two people and then you decide you will fund one of them instead of the other. So how do you do that? Is that the question?
What should the qualities of that person? Who is-
Okay, got it. So basically, what would make you to invest in one person over the other?
Yeah.
So I think and that's a case. So many times it's happening. People will come up from all the top colleges and similar ideas. So a lot has to do with also their experience, past experience. Maybe who has more experience, who's more mature. Because a lot of dropouts also nowadays. So while they're making great startups, but the maturity is very different from let's say a seasoned professional, right? So you also see years of experience in that industry. How has that been doing? And also maybe just his way of handling a volatile situation because startups is full of ups and downs. So maybe also how poised he is, because something that we've really looked at in founders is you have, because our portfolio is a mix of founders of varying like attributes. So like a calm founder, composed founder would probably react better in a situation as compared to founders are very aggressive. But of course, aggressive founders might also be able to build a scalable business faster. So the pros and cons are there. But I think also, how well he handles the business conflicts and situations and business volatilities would be one. And thirdly, how good he could be as a business leader. Because honestly, there was one startup which was something in the dubbing space. We've spoken to startups, everyone's superb on their tech. Okay, and they've like literally downloaded white papers which are released by IITs, etc., and build their dubbing tech around that. But what differentiated one startup over the others was, I think, one of them had a very good commercial or a business guy in place. So while the team was focusing on building the tech, this guy was focusing on getting them business. So just having tech is also not. So that business market is very important. What kind of a company what could be best? That's I think again one more reward like A's. That's I think again these A types. You see, hardly have anything in the books like data. Yes, that would be reward. Like these A. Yes. What else? Yes. You guys valuation syllabus and but yes, should be guys have like so then you have multiples of listed companies to write at a value which you mentioned use, which not in a is your value. How big the company should use public annual recurring revenue based valuation. I'll just use ARR because that's a short form for that. So ARR based valuation was even used for consumer brands. I mean, you tell me who are not whatever. What is the probability you're going to buy it every month? No one knows, right? Because you might buy something today, something else tomorrow. But then that's how it started happening that everyone started using ARR based. So even if a consumer brand today assumes that every month it will make at least 10 crores. Okay, वो तो मिलेगा ही मिलेगा, and then you gives you valuation on that. So it tends to be much higher than what a normal revenue would look like. So that is why those were absurd multiples if you ask me. And luckily now the market is corrected because everyone's questioning fundamental, seeing what it could actually look like, every month if a business goes high, goes low, etc. What is the actual revenue business can make? So that's how the market is corrected right now. And then you have comparable investment transactions. So of course, like you all mentioned, so if a similar startup has raised money in this space in the last few months, that's the best place. Okay, what is the multiple going around in the market? Even founders know that, it's a reasonable multiple because everyone's given that. So the negotiation also becomes much easier. And so, I think the best way to also go around getting a good hand in the valuation would be to read a lot of these industry reports would come up. So they give you very good insight into the industry, multiples, initiating coverages which you have with listed companies. So they're a very good source of understanding the company, how you value that company, what are the nuances of that business, etc. And also, like for example, you have if an IPO happens, like say of a farm easy. So you have the DRHP which comes out, draft red herring perspective. Again, a very good source to understand that industry and business in detail. So these things are very important for a venture capitalist to go through whenever they're evaluating companies. So day-to-day basis also involves day-to-day work involves a lot of reading up about these sources and downloading reports. And you also have a lot of databases. So we have Traction, VCC Edge, VC Circle, Private Circle, etc. that we use. So these kind of help you to extract data of relevant companies. And these are very venture capital focused databases. So that is something we use on day-to-day basis to get data whenever we're planning an investment in a transaction. So this is how entirely the methods of valuation look like. Any specific question here? Yeah.
Comparable investment transactions.
Yeah.
Let's say if we take a cred and let's say another payments platform or simple.
Yeah.
We know for a fact that cred right now is burning $727 for one worker
absolutely. Yeah.
Something like a smaller startup which is scaling much faster might be able to beat cred in the longer run. So what do the VCs look at before investing more money into a company like cred while not looking at a company like simple? So what's the
Right. So in fact, there's also a similar company called Check because that is something you're personally looking at, which is very similar to what Fred is building. But I think what someone would continue to invest in credit is A, they may be existing investors and so they're tied to it, so they have no other option. And secondly, if you invest in a similar business at a lower scale, they probably realize that utna cash burn to will be involved in that business. So might as well be invested in a slightly scaled up company where the probability of cash burn might reduce because credit has very good customer traction. So building that for an early stage startup might be difficult all of a sudden. So that cash burn can somehow get compromised at some stage. Maybe once you have less probably cash burn, because even if you see all of these companies, WhatsApp even was something which never monetized, okay, and then so all of a sudden it sold its business to Facebook just basically on the consumer transaction. So number of consumers makes a big difference, and higher the business, the larger the business, higher the number of customers. So that those are two things. And thirdly, I think also the founding team has gone through all the stages. So now they've seen, okay, what are the potential? I think Credto has done a lot of experimentation with different business models. So they have clearly seen what works, what doesn't. So for a new founder, he thinks, "Arey, मैं तो ये solve करूँगा, वो करूँगा," but इतने practically होता नहीं है. They realize कि at some point, okay, this is not working. So then that seasonality is there in an existing company, okay, which you feel like, okay, maybe somewhere he will figure out what's the right business model. So there are 2-3 reasons why they may continue to remain invested in credit. Yeah.
So, he also set a story on his Instagram that why is credit still not profitable? Why do you think that?
Yeah, but I think
Digit loss?
no. So I think what he had probably written about in Insta was more like around general tech businesses. So he's written that I think India does not in general understand tech businesses, and he had written that you know. Yeah, he had written that probably India needs to understand that once you invest in tech, you will burn some cash and it will take some time for you to become profitable. And if you really honestly ask me, I wasn't very satisfied with the answer. It was just a justification to defend his business, but it was a very non-logical answer.
What the data Fred is generating.
So that's what people are banking on. Maybe sometimes you'll monetize the data, monetize the users, etc. But so far he hasn't been able to. And even if you talk to a lot of consumer brands, they'll be like, oh, credit is a very important platform for discovery. So he's doing all those things as well. But unit economics are still not that great, I'd say. So yeah, and coming out of the answer, I don't think that really made a lot of sense. So I think this was just a way to defend his business. Yeah.
So my question was regarding when we don't have much data, the company is starting as a company beta program. At that time, how does we evaluate that company? Because does not have that much data. Like how much will it earn, or not full potential. So how much at that time? How do you evaluate that company?
So you mean, let's say it's just an idea on a paper. So let's say 100x VC, it's a micro VC, it does that. So a lot of times there are two ways. So they, like some of the VCs have a very fixed model of valuation. I will put 1.5 crores in each startup and take 10-15% equity, whatever. Just to giving a ballpark range there. So then usme they don't even put brains in valuation of any company, tech, non-tech, etc. It's a very fixed thing. 1 crore, 10% valuation, etc. That's how they value companies, which are like ideas on paper. That is one way. Second way is that maybe then it's you don't look at it as a valuation of the revenue. You look at it as a dilution of the founder's stake. So, for example, if he right now when you just come in, he owns 100% of the company. So you say that, okay, I want 10% of that company, but on what base you decide that percentage is of course something to do with valuation. But fundamentally, it's like an industry norm. Then remember, you do come in at the first stage, try to dilute or you take 15-20% share from the cap table. So that's how in that range you work out the valuations. Upper lower limit might be subjective to the founder, industry, etc. But you look at it more like a stake you would want in that company, so that it's big enough for you to make impact and help that company grow. That's how you look at it when you come in very early. Yeah.
But don't you think that including global companies will are different in the because the economy is different, GDP is different, demand is different, and that will create a difference in the valuation.
Correct. So right. So when I say we use comparables, they are the base. We also call like adjusted multiples. So we make a lot of plus minus adjustments based on not just even company, US or India. So not just country, even on the base of a company, because you don't find exactly same company. So you adjust the multiple. So let's say you will use that method to get an upper cap. Okay, maximum multiple, like the company's gone is 5, 6x, the lowest has gone to 3, 4x. Then you get a range. So within that range, then you also, do plus minus. And as an investor, you will always start with the lowest multiple. As a founder, you will always start with the highest. But एक वो bracket मिल गया, then you negotiate and come to a common ground. But I'm not saying you use that as an exact, pseudo multiple. Okay, I will also give this. It's used as a base, and you make your adjustments based on founder tech, etc. Yes. What else? Okay, so should we move to the next one? Okay, so next one is basically I will give you a gist of what this is. So we have also invested in a silver jewelry brand. Okay, so and like I said, okay, the first way we approach a company is we talk to, let's say we reach out to that company on LinkedIn, then we get him on a call, and the first call is usually just a 30-40 minute conversation where we cover some very key business aspects. Okay, so, for example, I'm not going to give an example because you will tell me, but basically we cover very important questions. That's where we get a very broad picture. Is it even worth taking it ahead or not? So, and these calls are very important because that's what decides, okay, if it is even worth taking the next stage. So all that evaluation thing I mentioned, that happens once you're convinced on that first call 30-40 minutes, okay, it's worth taking ahead. Because you're doing so many calls a day and evaluating every company in depth is like, it's just physically not possible given the bandwidth of the team. So you have to be very sharp in these calls to understand what questions to ask and how to judge the founders. So this is also a similar company from our portfolio as well. But I would want to let me just so this is like, for example, because when you reach out to a company, you just know it's a silver jewelry brand. You know nothing else about the company. And then you figure out a list of questions you should ask the founder so that you get information, you decide whether it's worth taking ahead or not. So if this is the problem statement you have, and let's say you all are on a call with the founder and you want to understand some very fundamental questions. So what are those key pointed questions you should ask the founder so that and then you tell me according to you whether, and I will answer all your questions. Let's say I'm the founder, you're the investors, ask me these questions, I will answer, and then you tell me if that makes a business sense for you to actually take the company ahead. Because it's like the first step we do when we actually talk to a company. So this is just a problem statement you have. Now I want you to throw as many questions you can. I will give you answers, and then then maybe we can just sum it up at the end and see if it's worth taking ahead or not. So just shoot your questions. I can keep writing them as well once you have questions. Yeah.
The supply chain, how they're sourcing, how much cost it is, and at what rate, at what margin they're selling.
Okay, so let's say supply chain. So I'll give you the answer. Let's say your supply chain is it's sourcing internationally. So it's sourcing from Dubai, Turkey. The designs come from there. It's a silver jewelry brand. Silver is also sourced by some of these countries and also from some jewelers, etc. So that's your supply chain. And what was the second question?
Margin.
Margin. Okay, so let's say this company has a gross margin of 76%. Okay, so this is the data you have. What was the third question? Okay, so we have two data points now.
What are the costs related to the supply chain? How much it can cost them to get it to the customer?
So I would say this, like for example, 100 minus 76, 24% would be the cost. Yeah.
What is the size of the venture?
Size of the venture, more specific. What do you mean by size?
In the industry, geography, and the value chain.
Okay, so let's take one by one. So when you say, yeah. So if industry size, I will tell you it is a $6 billion industry right now. Sorry, next question was?
And the value chain, how well is it managed?
Supply chain.
Value chain.
So,
functions.
okay, that's very good. Corporate governance is, let's say, good. He has a good team in place. Some
Last year's sales.
last year's sales, which is revenue. So let's say it's doing 10 crores a month, and also the term we use is MRR, monthly run rate. Yes. So which product? Necklaces and earrings. Yeah, so it'll be a small earring, it'll be a necklace will be a plain chain with a pendant. So it'll be a small like a small design. because like you have rings also very plain, maybe with small flower or a star over here. Okay, let's say on an average, blended margin would be 76, some would be 80%, some would be 70%. Yeah.
Internationally, so what if the global supply chain disrupts? What is your game plan?
Okay, so let's say my dependence on the global supply chain is 50%, and I still rely on India for 50%. So then, if something happens, I'll probably get hints early or,
You have inventory.
yeah. Retention, very good question. So the retention is 80%.
Projection of 4-5 years near.
Okay, so you mean what would be the revenue for 5 years down the line?
Revenue and
Projected revenue, so it can get to, right now it's what, 10 crores a month. Let's say it can get to 400 crores annually.
stream of service disbursement.
Wait, one sec. Oh, you had asked one question. Customer acquisition cost is, where was this? Okay, let's say customer acquisition cost is around 350 to 400. Yes. Sorry.
Customer service disbursement. What is the stream? A website or an app or
Got it. So that's called
stores?
channel mix. So let's say a channel mix would be, so you want to see website to market. What channel mix do you want?
Are there stores or are there websites?
No stores. It's all online. Yeah.
So what?
Sorry.
Is it a back office venture, and what's the manufacturing?
Back office venture meaning?
It's not it doesn't have physical shops, right? Website. Is it a back office venture, and what's the size of the manufacturing industry, or are you outsourcing?
So when you say size of manufacturing industry means what?
Are you manufacturing?
Are you manufacturing by himself or is he
Contracted. It's contracted. Yeah.
Product differentiator.
From no, so you're saying like Jiva's product differentiator from other brands in the market, like from let's say or Tanishq.
Basically, the USP of the product.
So USP would be it's an affordable brand because let's say a Mia by Tanishq or something would also come to 15 to 20K. So getting this range is difficult.
Little affordable.
Okay, so okay, I mean this is kind of Jiva, but okay. Yes.
Since you have a contractual base, what are the risk management measures in place if it falls apart? Contract falls apart?
So you're saying if the contract manufacturing falls off, so they have 2-3 contract manufacturers in place, so they don't have like a dependency on a single contract manufacturer. So let's say 33% for each. Yeah.
20 to 50,000 is a very large bracket. What's their average order value for
2,000. 2,000. Yeah, let me put that. Yeah, what did someone say? 2K.
Okay.
I will be investing on you, so I will.
Sorry, come again.
As I will be investing in you, so I will be more interested in finding an experience. Talking more about promoters, so I will be knowing your experience and how long you have been in the industry. After that, I will be asking the key drivers as those drivers and year-on-year growth on that, and the key major competitors that are already in the market. And if I get interested in that, I will deep dive into.
Okay, so founders background, they don't have a jewelry background. They have not, even worked in this industry in the past. But they've been like finance folks, IITs. One of them is a CA, one of them is an IIT, etc. Absolutely no industry in the jewelry market, no experience. And but they've been like sharp academic people, so who've been quite good with their academics, etc., and who've cracked good jobs. Like they've been consultants, they've been investment analysts, associates themselves. That's the background about the founders. Talking about sorry, what was the term? Key revenue drivers would of course be in terms of design of the product, because the But that's a question you should identify the key revenue drivers and ask me. I should not tell you that. You were very smart there. Okay. So the drive is because he identifies the white space in the market. He sees that this particular 500 to 15K price range has hardly any good organized players, a lot of artificial jewelry in this space. So, he's just like, I think it's a good market to make a play. And like he would have also identified the industry $6 billion, so big enough for him to actually, get a good market share. And what else? Money and yeah, okay, got it. So that way, yes, because he sees it to be a huge market. Because he's building a business, so he thinks it's a good business model. Yeah.
How many stock keeping units and what is the size between the order given and the delivery?
So you're saying time between the order delivery. Okay, so that's like a turnaround time. So his turnaround time would be, so let's say it's a normal e-commerce model because he sells on Amazon website, so 3 to 5 days. Like you also order how much time it takes. So 3 to 5 days. Your question was on SKU, stock keeping units. So just the context, stock keeping units are like the number of different types of stocks you have of a product. So for example, Lay's. So each flavor would be one SKU. Even within an Lay's, you will have 100 grams, 50 grams. So each of these will also be one SKU. That's what stock keeping units are, and I think that's what she was asking. So let's say this person has SKUs on a monthly basis of 20-25 SKUs because he changes his designs very rapidly. So he keeps rebuilding the SKUs. Yeah.
This is the go-to-market strategy because in jewelry segment, the gaining the trust of the consumer is very difficult in online stores.
Okay. So you're saying offline, what's the go-to-market strategy?
It may be a better one because in Indian context, gaining the consumer trust is very difficult because the goods are delivered after they are manufactured. Like traditionally, people can buy jewelry on offline stores after seeing and they can get the jewelry modified according to their needs. So, but
No, so I'm sorry, if you can just sum up your question, go-to-market strategy for what?
uh, like it is an online store. How would they gain traction of the customer?
So let me tell you that way. Let me answer that way. Right now, he's 100% online, but go-to-market would be to also build his offline presence very soon. So let's say this was COVID era, offline कोई खरीदना रही है, अभी कोई offline build करके फायदा नहीं है. But he would go, let's say 1 year down the line, he would go full on offline and he will build his experience centers. So where you're saying he will build trust, there'll be proper salesmen. Like how you go to Tanish, but a slightly low version of that because of the price range. He'll build experience centers and build trust.
What's the age of the venture?
Yeah, very good question, which should have come pehle. So age of the venture is 1 year old, 1.5 years actually.
So 1.5 is fairly new for a startup. Okay. Since there was already a question about the jewelry market, what can you say about your survivability in the market with the existing monopolistic industry players?
But is there a monopoly? Are there players?
Yeah, because
Which players?
in Indian context, coming again, the authenticity of the product, basically jewelry, is a very important constraint, and people always prefer those with a long-standing reputation, long-standing repo. So how can you survive in already established market?
Right. So my defense is there is no established market for this price range because I would say that some of my competitors would be Bluestone, Melora, Mia by Tanish, and Swarovski. Not even comparable. These are 3-4 companies. Let's say Kushal's is one jewelry brand, etc. If you have more names, you can give me. But these are some of the competitors which I have mapped out in my analysis, and I understand that our price range is very different. Our designs are like suited to fast fashion. So every month we kind of replenish and we redesign our products. So these are 2-3 points I would give in my defense. Yeah. You can give me some competitor names. As a founder, I don't know more.
What are the certifications that the client has?
It has all the certifications it requires, like the BSI, Hallmark, etc. It has all of that in place.
go to being offline will be in future. Right now, everything is online. So what
Yeah.
percentage is Amazon? What percentage is the website? And further, in the website, how many viewers, how many conversions, and what's the,
Okay, so your website versus marketplace, you're asking?
Amazon.
So yeah, website versus Amazon. So let's say website is website is 40 and Amazon is 60. Conversion rate is 4 to 5%. From the number of users who come, who view the product, 4 to 5% actually end up making a purchase.
Is that higher than the industry standard or lower?
I think it is as per average industry standards, not higher nor low, just fine, just okay. Yeah.
How many rounds of funding have you raised?
We've raised one round of funding so far. Yeah. So the last round, the question would be, what was your valuation in the last round? So last round of valuation would be, this is some hypothetical number I'm making out because I'm not giving out valuations, but let's say 100 crores. So 100 crores and 4.5%, how are you linking it? I didn't get it. Okay. So you are saying what out of the, let's say maybe 10K a month, 10K visits a month, and from that, or let's do a back calculation of 10 crores a month, average value is 2000. So, I mean, you can do it. So 10 crores a month, average value is 2000. So how many sales a month? That sales divided by 4 to 5% is equal to the number of customers who come. Is that clear? Because you're just doing a back calculation. Yeah.
Question first is, as you told, the founders are basically from IITs and I am academic oriented.
Yeah.
So do you plan to do some key additions in the team?
Yes. So probably when we go for funding, we need to hire someone to head growth strategy. So right now the founding team is in place, core team is in place, but different verticals. Even for offline, we need someone to head our stores. So that will have to happen post the fundraise.
Second is, since you told that there is valuation of 100 crores, so how do you plan to scale in the period of next 12 months? What's the plan?
Offline expansion is one. I will also hire a celebrity to do some brand endorsements, so create awareness because that should pump up my sales. And thirdly, also introduce a lot of new designs and really let's say maybe a lot of festivals are coming in the next few months. So make my designs more relevant to that.
What do you think about customization here? Is it suitable for your business?
Not really, because you have a lot of brands like Melora, which is just into customization, but we think that's not very cost effective. So we will ourselves create designs and everything and roll them out of the market, but customizing to each one's need is not feasible.
So when we look in the Indian society, people basically go with their design, even if we talk about marriages for that purpose. People go with their design and they show to the jewelry shop that this is basically what we want. Right?
Correct.
So that is how we have been working for traditions now.
Okay.
So what do you think about that?
So, like you said, that's for marriages. That's a big ticket sale. So, it'll be at least 1 to 5 lakhs, right? So, you're talking about 5 to 15K, which is as good as also buying artificial jewelry, which you have no control over. And this is daily office wear. For each my daily office wear, if I'm going to go tell him कि मुझे यार ऐसे earring बना के दो, ऐसे necklace बना के दो, I'll also go mad. So, I cannot customize given this price range. If I was doing 1 lakh plus, I would do that.
So do you plan to increase the price range as well?
No. Are you all done with your questions? You would invest in a company because it's Jiva, because you personally think it's worth investing. Sorry? Okay, yeah. So yeah, now that brings the next question. So that's a good point. Why you would invest, and that's also one of the that's a good hypothesis because his retention is 80%. So people come back and then so we use a metric called LTV time, which is called lifetime value by customer acquisition cost. So the way lifetime value would be like, let's say if an average order value is 2,000 rupees, and the customer comes back 80% is the retention rate. So he comes back, let's say 2-3 times again or whatever. So from one customer, I end up making 6 to 8K. Okay, so from 6 to 8K divided by 400. So that's my long. Let me do it. So let's say, for example, your AOV is 2K. He comes back 3 times, or let's say 4 times. So, the lifetime value, which means one customer can give me a value over his entire life of 8K. This is how much I can make from one customer. But how much am I paying to acquire one customer? I am just paying 400 rupees, right? So LTV by CAC, my LTV by CAC is basically 8,000 by 400, which is 20, which is a supremely high multiple. Okay. So I think that's why this is a very good, defense in terms of investing in the business. So this is also one calculation we end up doing, quick calculation. Why else would someone invest, not invest, given all this data that you have? Everyone would invest, or other people who would not invest?
One thing to be wary about is the fact that there's only 4.5%. Right? There's a good reliance on Amazon also. So that might be something that people have to look at. Because once a person becomes a customer, it's a good attention. But before that, it's primarily where the problem lies. Because it has no legacy. The one and all.
Okay, so that's a concern which we should get addressed by the founders. Okay, that's valid. So that is something you would look at as a red flag or something. But overall, would you invest or no?
The jury's still out.
Okay, let me not say invest or no. Would you take this ahead to the next step and is it worth even spending time on? Okay. What other reasons would you have for kind of considering this investment or not considering the investment? It's a personal call.
One, your business is already going so well. So why it is in such a need to grow?
Okay, so again, maybe he just wants to tap the market while it's hot. So offline expansion, while the brand is.
There's a whole unorganized sector in the offline.
Okay, so that is also a red flag, which is right, because also the point to add is your cost also increase. Entire unit economics changes. You have to pay rent and all of that. Okay, valid point, which we can, so these are some red flags. So let me highlight. So which is, we should basically, you would in a call identify these as red flags. Conversion rate was one and going offline was one. Okay.
Yet not incorporate expertise. So I would just hold myself back.
Okay, but let's say you don't have the money, because usually also to give a context, the way startup is with their core team, and the only reason they're raising funding is to build a good team. So if they don't have the money, kya kare? That's why they're coming to you for funds. Nahi karoge. Okay, ठीक है. So that is a big red flag for you. Okay.
Supply chain could also be one. International relations are not always.
Okay, so that's so basically these are points a founder should work on, and basically what you would do is if you identify these as red flags, sorry, you would make a note of these questions you want to ask him, and we send a mail to him. We need some more clarity on these, and then he comes back to us. So this is like a part of the data evaluation process that we also do. And to also solve some of our queries, we would tell him, the founder, okay, please make us talk to your team in these areas, so to understand what's their perspective and what's their expertise to actually manage these issues. So this would be a next step to actually, kind of clarifying your queries and clearing your doubts. So you're in the right direction, because once you identify some, concerns, etc., probably just list them down, which is, formally called a questionnaire. So if you think that a company is worth evaluating, after the call, make a question of all the questions you think you need answers for, all the data points you further need to make an informed decision. You send it to him, get on a call with him, get on a call with the team, visit the place, visit the factory, etc. If it's even making sense, if someone asks for manufacturing, see its facilities, etc. How good are they, how big are they, etc. And then probably take a decision on the basis of the data points you receive. Okay, so these are some of the points you said you would go back to. Okay. What other things would probably you do, or what other points do you have on this entire study? Yeah. I'm sorry, we're way ahead of time. I think it's 12. Yeah. But this is anyway the last part of this, because this was, I just want to give you like a feel of how we actually kind of probably deal or evaluate a startup. Yes, please.
Would they be willing to get funds for this?
But it is so small. Why would like they get acquired? Why would they build it in the first place? I mean,
So are they, get off the business and they like we get acquired if you offer us good value?
Okay, so that's a good point you brought up because I tell you there's this company called Mensa, which is basically like a house of brands. So what they do is they keep a lookout for these companies which are 1.5 years old, and their idea is to acquire companies on a 1 to 1.5x multiple of the revenue, and they acquire many similar brands like that. They will scale it up using synergies because all brands are in the same space, and then they'll set a massive valuation. So if at this stage someone would acquire them, it would be something like a Mensa, etc., which would give them 1.5x, which would not make sense. We're talking about the bigger players like a Melora, Bluestone, etc. It's too small, too early for them. I mean, they themselves could do something as big. So, and it's not even profitable, burning so much cash. But of course, later stages it could be a good target, but early might not be. But Mensa or something, really keep an eye for these brands. So great. So I think that's what we're saying. The purpose of this case study was to show, how a typical call looks like. Just the questions you asked me are the questions I would, or we as a team would typically ask the founder on day-to-day basis. So that's how a typical call goes like. And then from there we take it ahead and do our entire evaluation based on those points which are written. And that's how the entire process works. So like just some of the this looks messy.
So the totally right.
Please,
But
This one, right?
one.
Yeah. Yeah, so basically, your setup, which was I think a question which came very late, age wala, revenue of the company, margins in economics, founders' backgrounds, moat in the business, competitors, global trends. Oh, global trends, someone asked, no? You did? Okay. How big is the industry? Average order value, customer acquisition cost, retention rate, channel of selling, geography wise, someone asked. I missed answering though. Projected growth and how much you intend to raise and what valuation. I think you guys are bang on. Covered all the questions you would typically ask in a first call and probably follow on questions, once the founder keeps answering. So yeah, that was all about it in terms of how the entire process works. So again, that's just what I want to cover. Again, if you have any other questions or discussions, open for that. But that's about it. Let me know. Anything specific you want to discuss or get some insights on, would be happy to discuss that. Yeah.
Sometimes the company startup may want to set up a new manufacturing plant. Uh, so
Yeah, please go on.
when investing in these startups, which have their own manufacturing plant, what does that ownership who is owner of that manufacturing plant?
So you're saying, like, for example, when a startup goes into come again, contract
Manufacturing plants.
Yeah.
Own manufacturing plants. Rather than sourcing from other, it has its own manufacturing.
Yeah.
In that case, what are the that investment is from a particular person, right?
From the team only. It goes from the company's money.
Who does does that have any rights on that or that the new startup has that ownership?
No, if a company has its own manufacturing plant, the company will buy the manufacturing plant or set it up in its own name. So it will be like a capital expenditure in the books of the company. It will show as an asset. Also, I have a factory. So the ownership rights, etc., will rest with the company. Yeah. So there's not going to be an individual person owning the manufacturing plant. It will be an asset which belongs to the company. Just like any plant or machinery in the name of the company. Does that answer your question? Okay.
Let's say there's another Villa venture fund.
Yeah.
As well as this catalog everywhere. But thing is, you may be invested in the same company, let's say, credit in the SaaS industry, but you may be in different startups or competing startups in other industries. So how does that work between two competing venture capitalists when they're in the same, advising the same company in one place and competitors in the other?
So, but the space is different, right? So I didn't get it. How is it a same space? Like, for example,
There would be naturally be a competition that who gives the highest returns at any given point.
Yeah.
So what happens in a conflict of interest when both of them are advising the same company in one industry, but in competitors in the other? So what's the usual path that they take then?
No, so I'm sorry, just to get your question clear, let's say there's an Alphabet Ventures and Tiger Global, and Tiger Global is invested in credit, and Alphabet Ventures is invested in.
That is well. But
Okay.
in let's say another segment, another industry, there are two separate ways to invest. So how do you look look out for your players, or plan to gather your own future path for different ventures to make sure that you have a higher return than the competitor. So at the same time, while both of your returns will be the same for credit, because at the end of the day, valuation same hoga credit.
Right.
But if you have in different competitor industries or competitors in the same industry, what's your plan then?
Okay, so let's say, for example, Aditya Birla Ventures invests in a competitor credit, then that's what it means.
Different industry. Let's say
No, so if you just give me name, let's say Tiger Group is investing.
say an Ather and another EV startup.
Sorry?
Then Ather and another EV startup in the EV industry.
Yeah.
And same industry with credit, both of them. So yeah. So what's
that's sorry, I'm just trying to get myself clear on this. So let's say Tiger Group is invested in credit.
Yeah.
Aditya Birla Ventures invested in the EV startup. Yeah.
Only overlap is when both of them are invested in credit.
Okay.
Different industry, while both of them to give a good number of returns. Let's say one is an Ather for the EV industry. Let's say another is another one. Let's say Blue Swan. Slightly different industry, but still there.
Yeah.
But what's the procedure that they go ahead to make sure that there's a higher return than BlackRock or any other VC fund?
Okay, you're saying as a VC, how would you
As a
differentiate? Yeah. So I think, see, it's very. So let's say if I can talk for Aditya Birla Ventures, the way we would go about is, so we also kind of have a huge ABG global ecosystem. Okay. So if we take our consumer brands, they have very strong synergies with Aditya Birla Fashion Retail. And we also try to provide that to our portfolio companies. Healthcare, they would have some synergy with health insurance. The way, and that's also the point you asked is also a selling point. Why would even a startup prefer your investor versus another investor? So it's what operating strength you can bring to the business. So where we would differentiate ourselves in the moat is we have an entire global ecosystem of ABG open for our portfolio companies. You want to go global, you want to do some pivot with a company which is located in the US, you do that. You want to work with customers here in India with ABFR, do that. You want mentorship from a senior leadership, do that. So the way we go out of a way is opening our entire ecosystem. We've literally done that for our portfolio companies. And that is something maybe other companies, what like a Tyco Global or a Secor would have as an in-house operating tool, which would be these industry veterans, which are on a contract model, not necessarily on the payroll, of course. So that way, maybe the way you differentiate yourself is we have an in-house ecosystem. We can provide that and pump up the value, give you what mentorship, strategies, synergies you need. Other companies might do it in their own way. So I think that's more like an operating strategy, which is different for the others. But that's how we would differentiate ourselves at Birla Ventures. Yeah.
From a POV of startup, so two VCs invested in with acquiring the same amount of equity, which is more than 5%, giving them both a separate.
Okay, got it.
So their expertise and their influence is different. Right?
Correct.
What if they come to a mismanagement, disagreement in an internal meeting of which would shape the future of a startup? How would a startup tread regarding?
Yeah, and that is honestly very common. Okay, because nowadays, especially some investors are very high-headed and they want their thing to go on. So you have something like conflict resolution committees in a lot of cases. So that would basically have like a arbitrator, moderator who's independent of the investors. So sometimes you might take the issue to the conflict resolution committee and see what's their opinion on that. So how would he's more like an arbitrator judge in the court. Okay, what's your view? What's your view? And of course, the founder has the fundamental say as well. So that is one thing. You take it to the conflict resolution committee. Secondly, when you know there's a scenario where you have another investor holding a similar stake, you can tailor your investment agreements in such a way that when it comes to these matters, I will be the one having the upper hand, or I will be the sole decision maker. So, for example, if ABG has a synergy in a particular area, consumer related, so consumer related calls, we would be leading or we would take the decision on that, because the others might have financial expertise but not necessarily operating. So, these are 3 ways you can kind of decide who does what. Yeah.
Internalized to the startup, or they are a separate?
So conflict resolutions committee are, it could be it could be from the investor's point of view. Okay, like for example, the investor might appoint a conflict resolution committee, etc. Or sometimes even the startup might have it. It depends. But honestly, if you ask me, just to cut you there, startups don't have this. It's more of an investor thing, because two investors to come to an understanding would take it to something like that. Because even if you have a business, I mean, that's not your job, right? To get investors on the. It's more of an investor thing. Yeah. Yeah.
What role does the government play? Like we see, like Startup India, like program
Yeah.
like Startup India has recently boosted many startups, and we have seen many unicorns being born in the last few years. So, like, I want to think, what has the government played? What role has government played in the last few years that has boosted this?
Honestly, if you ask me, they've just kind of made the ecosystem friendly, but most of money is coming from non-government investors. So government also has a Made in India plan, etc., trying to do a lot of things, but I would still say a lot of it is on paper. Implementation is still a long way to go. And a lot of benefits are given honestly to retail investors in the form of tax benefits. And that's how their idea of promotion is. You invest in a startup, you get deduction under some section 80 or whatever. So all those things are there. But if I really talk about startups which has made it big, um, might not be that much in form of funding, but might be in terms of getting regulations eased out. So let's say, for example, if you have a huge fintech, you've seen the entire RBI regulation coming in place. So there, most of major startups might shut down if the RBI regulations are against them. So then, kind of lobbying with founders, understanding their concerns, and if trying to ease that out. So making the, process of doing business easier. So that's where government helps out, and it's also done that. RBI regulations kind of evaluating fintechs on a basis and see which fintech is good to go for a license, etc. So that way, it's trying to ease out the process, but not in terms of funding as much, more on the regulatory part of it, I would say.
Guys, so we are running a bit of crunch of our time, so I think you have any more questions? Srishti, could you please?
Good afternoon, everyone. I would like to extend my sincere gratitude to Sonakshi ma'am for taking the time to share your expertise with us during the guest lecture. Your presentation was both informative and engaging, and we greatly appreciate the effort you put in preparing and delivering it. I would also like to thank Rahul sir, Praveen sir, and Kishore sir to take the valuable time to attend the session. Lastly, I thank everyone for gathering here and making this a success. Thank you. Now I request Now I request Divya to present a memento from our team to Sonakshi ma'am. I request Rahul sir.
So today I didn't have a class, so I won't take much time. Okay. First thing, we all are active in various social media platforms. We could have come across one of the youngest achievers, Avril Bhatnagar, IIT and I Ahmedabad product. He's also a venture capitalist. And after that, I could see one of the youngest achievers like Ms. Sonakshi Gupta. And what is a good takeaway from this? You have come with, you have come to Nalsar with a lot of hopes and expectations to make out a career. So there are a lot of career options that are ahead of you. So venture capitalist may not be for the bigger ones. Even at younger age, you can start such. So after seeing Avril and after seeing Mr. Sonakshi Gupta, I was able to, visualize some of you becoming venture capitalists in the near future. And thank you so much, ma'am, for giving this kind of confidence to our younger lot here. Or in fact, I was making the notes there, the phone slipped off. It's right. So next one, uh, people can laugh at a joke instantaneously. It's like drug giving an instant kick, but the medicines do take some time for working out. Okay. So, ma'am, your words of wisdom are like that's a slow moving drug and all. So people may not respond at this point in time, but you have sowed some seeds of wisdom in their minds. It will not be now they think and they come back to us again because we have Null Street for the investors, we have eSell for the entrepreneurs, we have incubator is one such space. We are yet to experience a phenomenal growth because we had only one startup. Okay, that was coming up Law 101 from one of the law students. So far, any of our MBA or IPM students they are to come out with startups. But recently, I come across few people who are interested in coming out with their own startup plans. So then we got this idea: why not bring some venture capitalists? Why not have some kind of platform so that those people can come forward with their ideas? And right now, because it's the age where they have lots and lots of energy, right? So that's why the session has come to an eventuality, man. So going forward, if they do have any plans, definitely would like to reach out.
Absolutely.
Right, only for consultation per se. Okay.
More than happy to.
Sure, ma'am. Thank you so much. And yes, as we always say, the real freedom is financial freedom. Even in terms of advertising parlance, we have two important words: do nothing from Cadbury, or else taste the thunder from Thumbs Up. Right? So if it is do nothing, put your money in fixed deposits. You want to taste the thunder, put your money in. You become a venture capitalist, or else an angel investor. Choice is yours. And one more thing, ma'am, important raised, that is companies, even dating apps going to startups. We are talking about this point now. Dhirubhai Ambani thought of this much earlier. That's why through Reliance, he revolutionized the telecom industry across India. He started off with a 10 paise call long back 2001, 2002 times. It was one of the biggest initiatives coming from telecom sector. That's why you can see it is because of Geo we could use a lot of smartphones or else any other internet technology. Even now we are in 5G. Okay, even the launch of 5G, Baki sab, Mukesh Ambani spoke about Mataji, Pitaji, Guruji, right? Then 5G, they are more important. Okay, that's why we have one Guruji coming up and sharing our sessions to all of us, right? So, and that's again the reason why you guys have rural internships at the first year, so that you can go and access the rural markets first. You get a first-hand feel. Almost all urban markets, they are matured enough. Now you have to look forward, for towns and villages. First internship, focus on that. Next one, startups. Either you can work for a startup or you can come out with your own startup. That's why for second years we have internships in startups. Third year is when we're going to give an opportunity to work for industries. Okay, so that is the kind of plan we have for all of you. Okay, so yes, so our future vision is somewhere around 10 kilometers from here we have the Genome Valley. So with this kind of incubator and all, we want to create one more Silicon Valley in Nalsar. Utilize this opportunity. So before I close, ma'am, personally my choice, I will not make an investment in this XYZ company. Because one thing, there is no bargain here, because almost all gold purchases comes with a lot of bargaining, even established outlets as far as valuation is concerned.
Yeah.
Next one, I have alternative in the form of white gold, and no one did talk about the perception. No one did talk about the perception and the value proposition of the so-called silver ornaments. That's one thing. And second one, the market dynamics of gold. Because if gold is going to be very costlier, then where is the alternative for people to get into? Already Tata is very well ahead by bringing in this white gold through carrot lane concept. Okay. And why should I consider silver? What is the kind of positioning going to give for silver ornaments per se? Because last year, one of my students who did dissertation under me did online versus offline purchase of ornaments. So I could able to get very less participation in online market. Majority of them still prefer offline market. Okay. So because of these reasons, I will not make any investment in silver market.
Valid points. Yes.
That's how it is. Thank you all for joining us. We keep